Okay, Trustee Martin,
Here.
Trustee Moore,
Here, sorry.
Trustee Riley, and Trustee Worth.
Here.
Okay, all right.
Morning, Riley.
Morning.
So I just want to remind everybody while the meeting is going on, and if you're not speaking, please put your mics on mute. And I'm going to introduce Kelly and Matt, our consultants from NEPC, and they're going to be covering the first three tabs. First off, they're going to do the capital markets review and quarterly performance. We'll Tab 2 is an action item to update the investment policy statement. They will give us a review on that. And then we're going to have a discussion on the fossil fuel exposure in the fixed income portfolios, a discussion on how that's going. So without further ado, I'll pass the meeting to Kelly and Matt for our quarterly review.
Great. Thank you, Trustee Martin. And hello, everyone. Good morning. Hope you're all doing well. I'm going to share my screen now and turn it over to Matt, who will cover the first item on our agenda, and then I'll cover items 2 and 3. So let me just share my screen. Hopefully, can you all see this? Okay, great. Matt, I'll turn it over to you.
Great. Thanks, Kelly. Maybe let's move forward to the third. Yep, right here. So we just want to provide a quick recap of Q1. So clearly a lot of things have happened since the end of March. But the portfolio performance that you'll see later in the report all happened during this environment. So we thought it'd be best to show you how that performed, or remind you how it performed rather. And you might remember Q1 was sort of an ugly quarter for U.S. equities in particular, which is a reversal of what we've seen over the past couple of years. And this was despite some pretty good economic data that came through. Inflation started to moderate, job growth continued to be strong, but we started to see some more uncertainty come through on tariffs, which sort of weighed on equity performance. And then the Mag 7 in particular had a sell-off triggered in part by that DeepSeek announcement, which I think happened in late January, so dampening a lot of that US AI play that we had seen drive markets for quite some time. On the non-US side of things, represented by the MSCI EAFE, which is non-US developed, did pretty well. You can see up near the 7% range. A lot of this due to investors moving from US to non-US, but also bolstered by a weakening US dollar. So that currency component of the non-US returns really helped in that environment. And then off to the right there, the fixed income did pretty well as the growth concerns fueled downward pressure on rates, boosting prices there. And then finally, what's not shown on this page, but I did want to comment, which was a big dynamic during the quarter, was this value versus growth. So we've seen for past few years now, growth has really trounced value in the markets. And we saw a huge reversal of that in Q1 as market breadth expanded. Value outperformed growth during the quarter upwards of 12%, which was good for the fourth largest differential that we have seen ever. So that helped portfolios that were more diversified, and just something that we'll see flow through to the return dynamics of your managers. And Kelly, maybe if we move forward 2 slides to the trailing annual index performance here, just to bring you up to speed of how markets performed since then. So I think we're all aware, April 2nd, quote unquote, Liberation Day, or the announcements of the tariffs. We saw a huge spike in volatility, a huge sell-off across markets. But you can see in that April column there, really not quite as bad as what you might have expected after the first week or two in April. And if you sort of fast forward to today, markets, at least the S&P 500, has actually recovered all of the underperformance, and it's actually slightly positive for 2025. One thing that did continue from Q1 was the international markets continuing to outperform US. You can see the MSCI EAFE there up another 4.6%, bringing it near 12% year to date. So it's something we haven't seen where non-US outperforming US. That's sort of reversal from what we've seen over the past few years. And then on the fixed income side of things, it's sort of an interesting story here. As recession fears increased, treasury yields actually rose, sort of bringing down prices. So you see, at least in the U.S. component of the fixed income complex, a lot of those were down, which isn't something that you would normally expect as recession fears increased. And there was a lot of talk that you might have heard about, is the U.S. still sort of this safe haven environment when things in times of uncertainty, do people still flock to U.S. Treasuries? So there was some of that talk. Here at NEPC, we were watching that, but thought it was more sort of this technical sell-off related to things like tax payments on April 15th. And that's come to be probably mostly true as we move into May. We've seen yields come back down to where we would expect sort of in this type of environment. So interesting dynamic come through there, but something I wanted to point out, in particular that global ag, they're up 2.9% as people moved away from U.S. Fixed income into so more of a global positioning. All right, let's jump forward. I think PDF page 13, all the way up to just to show you where the Fed, where the market thinks the Fed is moving from here. So this page is as of April 4th, so a little bit dated, but to give you an idea where markets are thinking right after Liberation Day. Pricing in roughly 100 basis points of Fed rate cuts in 2025. This is really in contrast to what the Fed has been really consistent in saying, and that they're in this wait and see mode with no imminent cuts on the horizon, and that followed through with their recent announcement to hold steady, and that any rate cuts would likely come, if they do come, in later in the year. If you think back to the start of 2024, we were in a similar position. Markets were expecting, I think it was like 6+ rate cuts for the year, so pretty optimistic. But then we did see some, but it came in the last half of 2024, and not to the extent that markets were thinking. So it'll be interesting to see how we go forward. Is the market still sort of a little bit more optimistic than what the Fed has communicated, and whether the Fed maintains that more of a wait and see approach as we move forward. And then finally, on the next page, just to round out performance, talk about a little bit about our market outlook. We acknowledge that the recession risks are higher than what they were coming into 2025, but really it's still not our base case. A lot of it is going to depend on the tariff negotiations. We put this slide together when tariffs on China were still in that 145% range, and clearly we've seen some discussion come out that will likely be lower. But there's still a lot of uncertainty of what actually makes it into policy and where those tariff rates end up, and that'll dictate a lot of where the markets will go in the coming year. And with that uncertainty, we should brace for more volatility. We obviously have already seen this start of April and beyond, but given the uncertainty in policy, we should expect that to continue. In the face of uncertainty, NEPC really stresses emphasizing like rebalancing back to targets, in this theme that we talked about last quarter, which was be boring, be disciplined in your approach, be long-term investors, which really helps with volatile environments like this. And then finally, the last two here, just ensure sufficient liquidity. So not only can you meet your cash needs without selling in a down market, but also so you can rebalance back to target maybe when equity markets look a little bit more attractive. And then finally, like my previous comment, sort of stay the course. This old adage of time in the market is better than timing the market rings true in an environment that we have today, which is just much more volatile. What you'll often see in these types of environments is that equity markets in particular, when they have a huge down day, a lot of times the day after or the close few days after have a really strong rebalance. So if investors sell during a down market, they're more than likely going to miss out on the strong upside that we might see in the following days. So just something we wanted to emphasize, rebalancing the target and sort of staying the course as long-term investors. Any questions on markets before we move into the portfolio specific performance? Great. Okay, Kelly, if we want to move forward a couple pages, we'll start with the operating fund here. Currently at about 278 million, which was an increase of about 30 million from last quarter. A lot of that due to inflows, but we also saw some positive performance, up about 1%. Reminder, this is, the more conservative portfolio, mostly in cash and fixed income. So we wouldn't expect to see a lot of alpha here. So in line with your allocation index is what we expect to see and what we have seen over the long term. We don't have any we have one manager announcement rather with IRNM. We'll talk about that in a minute, but we don't have any recommendations for this portfolio at this time. On the pension, on the next page, is sitting about 16 million, a slight decrease, mostly due to outflows. We did have some slight positive performance at 0.1%. This is going to be more aggressive than the operating fund, a larger chunk to global equity at about 29%, still within in line with targets and ranges. The short-term performance here can deviate a little bit more from the allocation and policy indices, just depending on how managers are doing. And in Q1, some equity managers like Walter Scott was a slight drag on the quarter performance and over the 1 year. And then longer, some of the more defensive positioning like Lighthouse was a detractor relative to the allocation index. And then no manager announcements for this portfolio, but we do have that one recommendation to approve the IPS with the new targets that were discussed at the last meeting. Okay, on the managed investment pool, at about 370 million, a slight decrease, part of that due to outflows, but there was some negative performance, down about 70 basis points for the quarter. Still in line with targets and ranges. This is going to be more diversified portfolio, lagging slightly over the trailing time periods. Over the quarter, there was some growth bias within the domestic SMID cap, which hurt performance, and we'll see that here in a minute. And also there was this residual EM position that has since been liquidated that hurt coming out of the portfolio. And then more over the long term, at least 1 year, some equity performance, and then more defensive positionings with things like Lighthouse. On the rankings front, it's going to lag more likely in the long term, just given our expectation for this illiquidity premium. However, it's sort of unique over the quarter. You can see ranking 82nd percentile, but in down markets like this, where private markets have a quarterly lag, it sort of shows up as 0% in your total performance. So in down markets, that's actually a positive for portfolios that have large private markets portfolios. It's more of a technical thing versus anything that's driven by performance, just given the lag that we would see there. So no concerns at this time. And then we do have 2 manager announcements in Impacts and Westfield, which we'll talk about here in just a second, along with the approval of the IPS, given the targets that we talked about last quarter. On those due diligence events, the 3 that I had mentioned, Impacts, Westfield, and IRNM, only one, Westfield, has any recommendation as of a watch, and it's more of a soft watch. But just to take these in order real quick, Impacts, there was a large outflow in Q4 due to one of their investors, St. James Place, which is a UK financial services firm. They represented roughly 14 or 15% of Impacts' total assets under management and 7.5% of their firm revenue. They moved away from Impacts, not due to any concerns with Impacts as a whole, but due to more geographic positioning. They were underweight US and decided to take from some of their global managers and move them into the US to bring them back to target there. So something that we're monitoring just to make sure no turnover or any other concerns come about because of that decrease in AUM. And then Westfield, the one watch here, as I mentioned, Monex Group, which is an online brokerage and asset management firm in Japan, acquired a 20% minority interest in Westfield. And the goal with this partnership was for Westfield to sort of reach out of the US market and diversify its overseas channels. And they felt that Monex can really help with that. Although the investment philosophy, the leadership, the team, and the daily operations all remain the same. So no real concerns here. We've put it on watch just to be safe, but we don't really expect this to have any issues going forward. And then finally, IRNM, they're promoting their deputy CIO, Mike Sheldon, to co-CIO. No concerns here. This is part of a well-telegraphed transition plan as part of their long-term succession planning. So there are really no surprises here and no action recommended at this time. Okay, if there's no questions on those, we can move to the performance, and we'll start with the managed investment pools. There is a lot of overlap in the portfolios. Up here at the top, the SSGA and relatively new strategy in line with benchmark. It's going to differ slightly from the S&P 500 right above it, just when fossil fuels or energy outperforms or underperforms. So no concerns in that positioning. The one below at Westfield, I mentioned that in my earlier comments. This is a fundamental bottom-up growth or reasonable price manager. It outperformed its Russell 2500 growth index, you can see, but absolute performance wasn't great at 9.5%, just given the sell-off that we saw in equity markets, which underperformed the Russell 2500 index, which includes value, growth, and core. But so good relative to its own benchmark, bad given it had sort of this growth tilt, which didn't work well in Q1. Although in April, at least the early parts of April, we reached out to a number of our managers just to see how they were performing given the volatility that we had seen. Westfield at that time was outperforming the Russell 2500, and that's the straight Russell 2500, sort of that core benchmark. They were outperforming by about 40 basis points, but something that was good to see as we saw a lot of that volatility come through. Then Walter Scott and the global equity composite. This one was a little bit disappointing, frankly. I mean, January, they started off pretty strong. I think we talked about that during our last meeting. And so we would like to see that performance come through the quarter, but they ended up sliding in February and March a little bit. They don't hold a lot of the Mag 7, but they do hold some Microsoft and Alphabet, which was a drag on performance. But something that we would like to see better going forward. And they responded to our questionnaire in April as well. And they let us know that they were outperforming in April, at least through the 7th of April. They were down about 8%, which again, not good on an absolute basis, but they were outperforming their benchmark, which was down about 8.3%. So we'd like to see them sort of bounce back in Q2. Impacts, a similar story to Walter Scott in that they were doing really well in January, started to underperform a little bit in February and March, ended the quarter slightly down relative to its benchmark. Still, pretty decent performance given the wider equity market sell-off, but underperforming there. However, they're a better story in April. They outperformed by about 300 basis points in that first week of April. So I don't have most up-to-date numbers for that, but good to see that come through when we saw that volatility, and look to see that come through in the wider Q2 numbers as well. And then Lindsay Train, a real ballast for the portfolio. So we talked about Westfield being more of a growthy manager. Lindsay Train, which we put in recently, has that more value tilt. So while Westfield yin, Lindsay Train was able to yang, given their value tilt, and performed really strongly, up about 1.4% and beating its benchmark by about 320 basis points over the quarter. So that was good to see, and kind of a testament to why we like to diversify our portfolios across a number of different items, but particularly value and growth. And then finally on this page, Silchester, as I mentioned at the top, non-US equity developed was the place to be. They had some pretty good absolute performance. Underperformed the MSCI EAFE slightly, but no real concerns with Silchester at this time. And then on the following page, fixed income. This has been a real strength of the portfolio. It's outperforming in all time periods except slightly in this quarter, but still doing well. And then ranking above median in all time periods. And you look out towards that 10-year time frame, ranking in the 28th percentile and outperforming its benchmark by 120 basis points. So really strong performance coming through here. A lot of that more recently, at least this quarter, you can see Fidelity ranking in the 1st percentile. This is more due to just where they are, their maturities that they held in the portfolio and where yields fell the most during the quarter. But you look out longer term, BlackRock and Bain have been the real drivers of alpha there, particularly Bain. You look out the 5 years, up 8.9%, as leverage loan was the place to be over that time period. Moving down into GAA and hedge funds, it's going to be more of a portfolio that's going to provide more downside protection. Newton, you can see, was up 1% for the quarter, right on top of its benchmark. But providing that downside protection when equity markets fell, it did pretty well. Similar story to Lighthouse, although it was down about 1.4%, still not as much as what you would see or what we saw in equity markets. and it is underperforming its benchmark, but hedge funds are sort of notoriously difficult to benchmark. And it's ranking in the 50th percentile. So keeping up with its peers there. But it alongside Newton not going to be down as much as your equity markets, providing a little bit of a ballast there. And then finally, Landmark. This is the one private markets manager. I think we say this every quarter, but this isn't really the metric you should be measuring these on, since these are time-weighted returns. We do have some IRR returns on a later page. And this is as of, I think 9/30, because end of year data is even more lagged for quarterly or for private markets. So at the time, 9/30, it was up about 10.7% for its IRR, which was in line with managers of similar strategies. And then in the pension portfolio, a couple of the managers we haven't hit on yet was Baird. Now this is in line recently, outperforming over the 1 and 3 year time periods, and ranking above median in all time periods as well. Their performance driven largely by credit selection. They tend to be a little bit more overweight in the BBB space, which at least longer term had done well as spreads tightened. And then Principal down there towards the bottom, slightly negative performance and underperforming its benchmark, but roughly in line long term. And this is just going to be driven by a lot of the dynamics that we see in the real estate market. And then finally, PIMCO on the following page towards the bottom, in line recently, outperforming 3 years and later. This is going to be a little bit more different than peers, where it's going to have, peers are more 60-40. PIMCO is going to have a little bit less equity exposure. So again, when equity markets are down like they were, they're going to rank a little bit better than peers. And you can see that in Q1, up in the 19th percentile among peers. The goal here isn't to provide, super strong absolute performance like you might see in equities in some markets, but to provide more of a sort of this steady state absolute return profile with some diversification, particularly as it relates to inflation protection. I think that rounds out all the manager performance and our performance and market comments as a whole. Are there any questions before we move to the other items?
I hate to take up any significant amount of time talking about private equity, given the size of it in the MIP. But if could you just clarify a little bit, at least for me, if not for anybody else who's a little bit confused by the difference in report and in return kind of characteristics between the IRR and the lag time periods and that type of thing, first off.
Sure.
And secondly, do you have any kind of general outlook on private equity versus other asset classes? I think your recommendation in the past has been potentially that we consider more, but just wanted to get an updated view on that.
Sure. So the time weighted versus IRR. So IRR, for those who don't know, stands for internal rate of return. It can also be said as like a dollar weighted return. And so what that takes into account is when dollars are actually going into the portfolio. So let's say you start with $100 and the private markets manager who controls when they get those dollars through the capital calls, which is different than other public market managers where you control when that goes into the market. So they're controlling it, and let's say you have $100, they call $5 worth, and they have really strong performance with that $5. And then they end up calling $50 after that. So you've invested 55 of your 100, and in that second time period, they underperform pretty handily or do not as well. Your performance there on an IRR basis or a dollar weighted basis is going to be a lot worse, because most of the dollars were invested when the markets underperformed. That $50 came in. Versus you think about on a public markets manager, because they can't control when they get dollars, they're sort of just investing in perpetuity effectively. We don't want to judge them on the same characteristics. So we want to judge them on what we call a time weighted basis, which strips that out and is going to sort of geometrically link the returns of each month. So each month sort of has this equal weight of performance, so you don't get these flux based on when you actually invest the money. So it just really accounts for when dollars go in and when dollars come out, and judges the private markets managers on that since they control it, and doesn't judge the public markets managers on that because they can't control it. Does that answer your question, at least for that part of it, Jim?
Sorry, unmuting there. Yes, it does.
Okay, great.
I appreciate that part of it. Thanks.
Yeah, no problem. And then our outlook for private markets. This is a little bit more difficult. A lot of it's driven on the outlook here is like, when do you get distributions or when they're going to call capital? Because in environments like right now, we're seeing not a lot of distributions come through. I mean, the IPO market for a long time has been dried up almost completely. And so not seeing a lot of exits of those portfolios. So what we're seeing instead are these managers holding on to investments longer, extending sort of the harvesting period, and the life cycles, which can run upwards of 10, 12, 15 years in some cases. So that's something we're really seeing, and the dynamic between when investors get distributions and when they get capital calls is unique. I think within private markets and private equity in general, we're seeing a lot of uptake in things like lower middle market environment, just where we focus a lot of our time. We feel like that's in sort of an alpha-rich opportunity there. And yeah, I mean, I think there are some interesting dynamics coming out of private credit, just given where, you know, rates are and some changes that we've seen over, you know, from the zero interest rate environment for the past, you know, 6 years. So some higher rates have put in some interesting strategies there. Otherwise, I'm trying to think of other outlook items. Kelly, I don't know if you have any comments there in terms of, you know, positioning or anything in private markets.
Yeah, no, Matt, I'd agree with everything you said. In terms of, I think part of your question, Jim, is I think I heard you say, you know, we've recommended to you in the past to look at private markets. And in terms of the managed investment pool, when we look at other endowments or even foundations of similar size, what we find is that your peers have around, you know, on average, about a 10% allocation to private markets. So when we talk about those peer rankings earlier in the presentation, there's always going to be a wide difference in your rankings because of that dynamic and some of the things that Matt mentioned earlier. So we have profiled kind of what it would look like to have a 10% allocation to private markets, what that could do to risk and return. You know, as note, we still believe in the illiquidity premium of getting anywhere from 2 to 3% above public markets. That being said, if the University of Maine system were to go down the path of putting in a full private markets program, there's a number of things to consider, but also understanding that it would take time for those returns to come through into the portfolio, because I'll throw out a term here, just the J curve. What you usually see in the beginning of a private markets portfolio is all the capital calls. The managers are calling capital from the University of Maine system, and none of those distributions have come back. So what you'll see is most likely negative returns in the early years of a private market program, as it takes a good, you know, 5+ years to build it out to a well-diversified program. So in terms of the managed investment pool, you have a return objective. We can meet that return objective with the portfolio that you have today. So putting in private markets is not something that's needed at this point in time to maintain that return objective. That being said, if there is a desire to have returns more in line with peers and some patience to build out the private equity portfolio, that is when we would want to probably consider private markets for you.
Thank you guys so very much. Appreciate that.
Yep.
Any other questions? Great.
Okay. Matt, do you want to turn it over to me now for the
Yeah.
policy? Okay.
Sounds good.
I just have to get to it. There we go. All right. So hopefully you can see this. Okay, I'll try and make it a little bit bigger. This is, I have a red line copy of the managed investment pool policy, and I'll go through the pension fund as well. We've also included the clean versions in the materials that were posted to your board website. As you remember, at the last meeting, we made a number of asset allocation changes. So what I'm showing here today is just the red line changes to your policy to codify those changes that the committee has already approved. So just, you know, cleaning up the document in terms of the date, you know, in terms of your spending policy, again, you know, updating the document for the appropriate fiscal years for the spending policy. The majority of the changes are here within the equity portfolio, in terms of just, kind of updating what our targets are that the committee approved for large cap, small cap, and emerging at the last meeting, and putting in the appropriate benchmarks for that. Down here at the bottom of the managed investment pool, just updating the spending rate language for the fiscal year 2026 that you all approved at your December 2024 meeting. So just codifying that. And then as I move back in the document, go a couple pages here, there is some language, and we talk about, the purpose of the investment policy and who invests in the managed investment pool. So we have a number of third-party investors listed here, and we deleted the University of Southern Maine Foundation as they were removed from the managed investment pool last year. And then the other change here is we had said that the annual spending amount is calculated using a 3-year market value average. Actually, it's a trailing 12 quarter market value average. So just cleaning that up and getting it so it aligns with how you're actually looking at that spending amount. And then later in the document here, there is another asset allocation table, which coincides with the first asset allocation table on the summary page. So those were the updates, nothing significant, mostly cleaning up some of the language around spending policy, as well as codifying the asset allocation changes that the committee approved. Let me stop there. And John, it looks like you may have a question.
Yes, I was just reading it over. What about the Foundation for Presque Isle? Did they not invest in the pool, or did they not have any? I'm just curious. I didn't see them listed. Or did I miss them?
Tracy, I'll ask you to comment because I'm not too familiar with all the third-party investors and if that should be added or not.
Thank you for the question, Trustee Moore. I will get back to you on that. I'm not sure if maybe they invest in the endowment, University of Maine System endowment allocation, which may be why you're not seeing that detail here. But I will look into it and get back to you.
Okay, thank you.
Any other questions on the managed investment pool policy before I go into the pension fund? Okay. Let me get there. It's hard to see with these tabs. Here we go. Okay. So here, less changes than the managed investment pool, but similar in nature. Just changing some of the asset allocation where we removed the emerging market allocation per your approval at the last meeting, and some date changes. So this is really the only update for this investment policy. Later on in the documentation, you'll see there's no red lines here up until we get to the same table again in the middle of the document. So very minor changes for the pension fund. Again, just codifying the asset allocation changes approved. Any questions on the pension fund before I turn it back over to Trustee Martin to read the action? Okay.
Thank you. Thank you for that, Kel, and I'm going to go ahead and read the text of the proposed resolution on the update of investment policy statements. That the investment committee approves the updated investment policy statements for the managed investment pool and the pension fund. Can I have a motion?
So moved.
So moved by Trustee Moore. Do I have a second?
Second.
Second by Trustee Chair Riley. And Beth, can I have you please take a roll call for the vote?
Yes, Trustee Martin,
Yes.
Trustee Riley,
Yes.
Trustee Worth,
Yes.
Trustee Moore,
Yes.
motion carries.
Excellent. So I will pass the meeting back to NEPC for the discussion of fixed income fossil fuel exposure. And thanks for the tab 1 and 2. Enjoyed the quarterly performance review, and thank you. So without further ado, I'll pass it back to you for tab 3.
Okay, great. Thank you so much. So we're going to talk about the fixed income exposure across all three portfolios and how that relates to fossil fuel exposure. And so just to start here, just as a reminder, the investment committee approved the reduction in fossil fuel exposure across all three portfolios back in 2022. And what we use to determine fossil fuel exposure is looking at the Carbon Underground 200 and asking managers what their exposure is to that specific list of 200 securities. We have made a lot of progress in terms of reducing the fossil fuel exposure across all three portfolios. In fact, all of the equity managers across all three portfolios no longer have any fossil fuel exposure. So that was a project that we've taken on for the past 2 years, and we've made significant progress to maintain the expected return of the portfolio, maintain high quality managers within the equity portfolio. And so our next area of focus now is the fixed income portfolio. And where can we reduce fossil fuel exposure from the fixed income portfolio? I'm going to walk through Matt and I's assessment of the landscape in the fixed income world. There's no recommendations to here, but more so a discussion that we would like to have with you all on kind of next steps. And our goal would be to bring back a full analysis to you at the next meeting with a recommendation, but wanted to discuss the landscape and some of the things that we should be discussing before coming back with a recommendation to you all. So just as a reminder here, we've listed out all the managers, the fixed income managers across all three portfolios. Some of the managers are just in one of the portfolios, some are in all three. We've listed that here in this column for you, along with the assets and what types of vehicles these managers are. Are they a separate account where we can direct them to reduce fossil fuel exposure, such as IRNM down at the bottom in the operating fund? Today they have no exposure, as you can see, because we've directed them already to reduce that exposure. There are two managers here, the Common Fund, which is a Barclays aggregate manager, and the MIP, and then Baird, which is a Barclays aggregate manager, and the pension, the operating fund, that have given NEPC data to say that they have about almost $600,000 of exposure across the two of them in the Carbon 200. And so we have them listed here in this column. I also wanted to point out BlackRock and Bain. So when we go through our fossil fuel analysis at the end of every year, some managers don't have access to the Carbon 200 list. So they give us what their exposure is to all fossil fuels. And so BlackRock has said they have about a 3% exposure to fossil fuels, and Bain has almost a 2% exposure to fossil fuels. Based on what NEPC can tell at this point, we don't believe that their exposure is the Carbon 200 underground list, but we can't know for sure until we have access to that list. And so we'd like to ask the system, and we can work directly with Tracy, for Tracy to reach out to the fossil fuel index providers and request that list. Our understanding is that it may be free or a very small nominal fee to receive that list on a quarter look back. Once Tracy has that list, we can send Tracy the securities that BlackRock and Bain hold and say, hey, are these securities on the list? Tracy can't share that list with NEPC or the investment managers, but we can kind of work backwards to try to see what the exposure is. So for today, we're just going to focus on Common Fund and Baird because we know that's true Carbon 200 exposure, and we're going to hold off on Bain and BlackRock until we know more. But again, we're pretty sure that their exposure is 0 to the 200, but again, just want to make sure. We have profiled what you'll see on the next few pages, some different strategies across the fixed income space that we'll discuss with you. Really want to get a feel from the group on how comfortable you are with, should we just look at strategies that have been through the NEPC due diligence process and are rated at NEPC? Is there openness to look at some other strategies that may not be on our top part of our approved list in terms of kind of ratings? Also want to look at, is there openness to, moving down into more separate accounts like you have with IRNM, where you have the more flexibility to direct the exclusion of fossil fuels. Again, there's a little bit more time that's needed to go through the paperwork and certain things of that nature. Certainly, it won't be anything like what we went through previously with Newton, a little bit more straightforward in the fixed income space. But again, just a consideration out there for everyone to think about. So moving forward here, this first page is just looking at the commingled funds and mutual funds that are available that do not have fossil fuels today. So up at the top are just the two managers that you have today with their fossil fuel exposure listed. We've also listed their annual investment management fees and kind of liquidity. Down here at the bottom are some potential replacements that we have found by one going through our approved list of fixed income strategies and working with the managers to understand their exposure, as well as using some screening tools through eVestment to look at what other managers are out there that have strategies that would not invest in fossil fuels. So Garcia Hamilton and DoubleLine are two one-rated managers at NEPC that work in the Barclays aggregate space, just like the managers you have today that could be considered, and they do not have any fossil fuel exposures, just based on their process, not because they actually exclude them from their process. Meaning there could be a point in time where these managers could have exposure to fossil fuels depending on the opportunity set. So today they don't have them. Most likely they won't have them. Similar to Lindsell Train in our global equity space where, they typically don't invest in energy. Not saying they can't, but historically they haven't. So again, just want to point that out here. And then down at the bottom, just 4 other strategies that are more impact investment oriented. PIMCO with an ESG strategy, and then some impact strategies across community capital and RBC. All of those are rated 3 at NEPC, which is just a neutral rating. But again, strategies that we have found that more so in their investment process and their policy that they would not invest in fossil fuels. What you'll see here for fees is that most of these strategies in this commingled fund space that I'm profiling here have higher fees than what we have today. So again, just another consideration. The other option is, we can include the commingled fund managers, but we could also look at some of these separate account managers. So what you'll see here is a list of investment managers and strategies that are either rated 1 or 2 at NEPC, with the exception of Breckenridge, and I'll get to that in a moment. But all the other strategies rated 1 or 2, we've reached out to them, and you can see that in this minimum column, this is the minimum dollars that they need to run a separate account for their clients. And the majority of these have said that they will aggregate the assets across the MIP, the pension fund, and the operating fund to have one separate account that can be parsed across the 3 portfolios. So, these minimums, we have about, I think, 45 million or so that we're working with. So, we can access many of these managers. They all have daily liquidity. And what you can see here in the fee column, it ranges from about 20 to 35 basis points for fees, so a little bit lower than the commingled funds. And with these managers, you would actually be able to put into the investment guidelines, the separate account investment guidelines, exclude the carbon 200, and you would know for certain and for a fact that you would not have that exposure going forward. We also included Breckenridge that's not rated at NEPC, but they are a fixed income manager that really only works mostly with separate accounts. They have a strong history with managing separate accounts and also working with some type of sustainable separate accounts as well. So again, have the capability from our understanding to work through this type of strategy that we're presenting. But again, it's just not rated at NEPC. So we've listed some performance here. I'm not going to go too in depth to it, but generally to say that the performance across all these strategies on a historical basis, and again, that's not indicative of how they'll do going forward, but just looking down the 10-year column over the longer term, most of these strategies have outperformed the Barclays aggregate. Most are in line with the managers that you have today. So again, not so much concern from a performance standpoint from moving to a different manager here. So just to wrap up, maybe I'll just stop and see if there's any comments from the committee on, based on the information provided in terms of, what you're comfortable with us in terms of putting together the future analysis. Do you want to focus on separate accounts only? Do you want us to include some of the commingled funds? Do you want us to focus just on 1 and 2 rated strategies at NEPC and exclude the 3 rated strategies? We can start with the full list that I'm showing you here and go through the analysis and come with a recommendation. But I just want to make sure that we take in any of your preferences before we do so, and work on that analysis. So I'll just stop here and see if there's anything I said that raises questions or gives you an idea on any of those preferences that you would like us to include in the search.
Any preferences, questions, concerns?
Trustee Riley?
Yeah, thanks. I think the key for me, Kelly, is that we sort of trust your judgment, obviously, and look for your recommendations that can balance our returns with our goal to get out completely by 2030, right? Isn't it 2030?
Correct.
And so that's only 5 years away. So it's sort of like, where do you think we can find that sweet spot between appropriate investment returns and getting to our goal? And if your recommendations hit that, I think we're in good shape.
Okay. Comments from anyone else?
Just from from an SMA standpoint, I mean, my understanding is that would probably be the cleanest way of being able to produce a list of 200 companies that you don't want to include in an SMA, and they're just not going to be there, period. It's not a whole lot of guesswork going forward, I guess, if that's the criteria we wanted to use. So.
Agreed. So what I think, if it's okay with all of you, what we will do here, Matt and I will take this separate account list of these, 6 or 7 managers, and we'll work on the analysis and find the manager that we would recommend to you that fits with the other fixed income managers that you have in your portfolio, and do some analysis on that and come with a recommendation to the next meeting, given that, we'll have for certainty, 1, the fossil fuel exposure, and 2, the fees are, lower than kind of what they are for the commingled funds as well. So that's an added benefit. And so Matt and I will take that back and complete that analysis for the next meeting. Okay. Well, those were the end of our prepared comments. Is there any other topic or anything on top of mind that you'd like to discuss with us?
Sounds like that's it. Any other questions, comments before NEPC steps off? Just want to really thank you guys for, somebody.
I think we should let Kelly know that Tracy did a great job in her absence, and thank you for all your help at the full report at the board.
Oh, wonderful. Wonderful. Thank you, Tracy.
Deserved vacation.
Yes.
Thank you so much. I'm glad it went well. That's great to hear.
Did.
And
Well,
thank you for that. Also, if I can just, before we end the session, answer Trustee Moore's question, in that the UMPI Foundation does not invest with us. I'm not sure where they invest, but they do not invest through the university, just the Fort Kent Foundation.
thank you for that. Thank you, Kelly and Matt, for your information. Very informative. And I guess we'll see you on the next season. Have a nice summer.
Sounds good. Thank you so much. We'll be in
Thanks
touch
all.
with you.
Bye.
Take care. And let's see, has Barry joined us yet?
I don't see him, but I am sending him an email now. Maybe we take a 5-minute break. I think we ended a little early.
Yeah, we are quite a bit ahead of, about 40 minutes ahead of schedule, so
Mhm.
get a bonus. We get a break in the meeting.
Kelly, I have a question.
Yes.
So I'm just, trying to get this around my head some, but the more investment, the stronger the overall portfolio, correct? I mean, in general, the more we have to invest, the more options and the stronger the portfolio can become.
I don't know if that's, yeah, not necessarily. I think that the people that join us for, Tracy, you want to jump in on this one? I think that the more that we have, the people that join us get to have a break. If
Yeah.
anything, am I getting that right on that? It basically economies of scale.
Right, right.
Yeah.
So
But
I didn't,
I
Sorry.
think, John, the reason USM pulled out and UMaine remains independent is they get better results. We obviously need to be with public dollars more conservative in our investments.
Okay.
So I think we ought to, it's a good question, because obviously the economies of scale are real. But we ought to probably find out from USM how their returns are going compared to where they were, and just get a sense if that is in fact correct.
yeah, that was kind of my point was that where I don't know how much, maybe they don't have a lot, but Presque Isle, where are they investing, and do they want to partake of the economy of scales of the system? And then same thing with USM, you know, sometimes the grass is greener and then sometimes it's not, right? I don't know how that works as far as going back and asking to take another look at that and invite them back in, or I don't, you know, how that, maybe that's not in part of the realm of this committee.
Well, we do an annual, they've only been out a year, so, and it's been a pretty funky year, but we do an annual report on fundraising at the board level. And maybe when we do that, we ask to do a comparative. Would that make sense? And see where they are versus where we are?
Yeah, I'm not 100%. I think I'm going to defer. I'm going to make a comment, general comment that, you know, when people are investing money, it's all based on goals and objectives. And, you know, our portfolios have specific goals and objectives, and some of our portfolios have to be more conservative because, you know, there's a use factor. The money needs to be used at a certain. So when everybody gets together, if the goals and objectives are all tied to the specific portfolios for specific reasons, then the way that you invest, it's going to determine the way you invest. So if their goals and objectives are different, then take, for example, if we looked at the pension fund, that we have to be, you know, we got liabilities here, you got to be very safe with that. So there's different goals and objectives, which means that dictates how the money should be invested. And with other people coming in, they have different goals and objectives. I'm gonna, Tracy, if you don't mind, you know, adding to the discussion based on your history with different entities, being a part of that, why they do, and you know, why sometimes they do leave. You know, if you could add to that conversation.
Happy to do that. And I would start by saying the Yampi Foundation, to my knowledge, has never participated, but I believe they're well aware that we exist as an opportunity, but I'd be happy to reach out and have that conversation with them to see if they're interested or if it's would be helpful to them. Oftentimes, third parties reach out to us to participate because they lack the administrative capability to manage portfolios, or by coming into our portfolio, which, as you mentioned, is larger, there are economies of scale. We can spread the consultant costs, other sort of manager fees, and because we have larger investments, we are able to get better fees with managers. You know, but we don't do things like private equity to any extent because we have a mandated reporting to the state of Maine of November 1, and the complexity private equity adds. And we have a limited staff as well, so there would be need to be some additional resources there. So there's all that sort of complexity. You know, I think it's a personal decision. Some want more control. Some of the foundations want more control over their assets. They want to invest directly in equity. They want to work with their own financial manager and be control of their own portfolio outcome. But it's often when they choose to invest, it's because we can offer that administrative service that they lack the resources for the most part.
And Tracy, could you I mean, does it benefit us in any way, or is the benefit mostly on them?
As far as benefiting us, I mean, certainly a lot of the resources are a benefit to us as an institution. Them coming into our portfolio, quite honestly, is more work for us. It's something we just do because obviously, we consider ourselves partners, but it is more work for the accounting staff. As far as the investment side of the house, it's really not. And, I mean, it takes some effort to bring them in and to disperse quarterly and to liquidate, but it's not an additional burden generally on the investment side. It's more the accounting administration and things like that.
That's good to know. Good to know. Any other questions regarding Trustee Moore's question? Okay, great.
And I would
Barry.
also say that Barry has joined us. I was able to connect with him. So thank you.
Like, wow. They did a
Barry has entered the
whoopsie.
room. So Barry, welcome.
Yeah.
We're rolling pretty quickly here, so we're 40 minutes early. Apologize for that. Thanks for jumping in.
Yep.
So I'm going to pass the meeting to you to go over the quarterly review. Actually, you have the next 3 tabs: the defined contribution plan, quarterly review, and then a little bit of discussion on the fee benchmarking and share class analysis, and then our final tab, the small company value fund change recommendation, which is a voting item. So without further ado, Barry, you're on.
Yeah, and just one correction, the tab 6 should say foreign large blend fund change recommendation. It just was I think that was from the last trustees meeting.
Okay.
So I think Nate is going to be joining in a minute. So in the interim, I'm going to share my screen. Do you all see this?
I do.
Okay, great. And just a guide, like we could certainly talk about the market. I know you all heard that from NEPC, so guide me a little bit with respect to whether we want to go to the market commentary as well. Any thoughts?
I think if you want to do that at a high level, that'd be helpful, Barry.
Okay, all right. And I'm going to kind of guide that into the fund that we're going to talk about later. So I'll at least want to make some comments on that. But as we normally do, each quarterly review, we want to make sure the committee has a cursory knowledge or cursory review of things that are happening in the marketplace. As you all may recall, we've been talking about Secure 2.0 for probably the last 2.5 years. And this is just a reminder, there are a number of optional provisions. I think the University of Maine system is exploring whether or not they want to incorporate those into the plan, such items as emergency withdrawals, federally declared disasters. That's been one most of my clients ultimately have elected to implement. Not many are doing the self-certification of hardship withdrawals. There's too many. It's wrought with potential concerns on over or abuse of those particular provisions. So we have not seen many organizations, plan sponsors offer the self-certification. Student loan matching is something that is maybe more case by case. I have not had any plans implement this, although we've had several plans consider at least having the discussion. This, as you recall, this is a particular provision that if somebody has a student loan, they can be at least the company match or the plan sponsor match portion of that in deference to them putting their money into paying off their student loan. They could have the match portion of that. So it's really more case by case specific. But again, I've not had any plan sponsors implement that one. Auto portability, this is things are going to be emerging. I don't think TIA is quite there yet, but if somebody leaves the University of Maine system plan, a faculty or staff member, they work for University of Maine system for only a number of years. They accumulate $3,000–4,000. this is intended to that money follow them throughout their career automatically. So most of the major record keepers, TIAA, Fidelity, Vanguard, Principal, have all been part of this consortium. Ultimately, so that when that participant leaves, they join a new employer that might have Fidelity as an example. Ultimately, that money will flow into the new employer's plan. Those are ones I wanted to just talk about briefly. We do offer a participant level advice service, and last year in 2024 we had over 20,000 phone calls, and 12% of those phone calls were for people that have abnormally high financial stress. And if you think about kind of that chart as we got, it's as we got near the election, we started to see the financial stress certainly increase. When we had those phone conversations, it was interesting that rarely, and I'd be interested in TIA's analysis of this as well separately, but rarely did we talk specifically about the investments or retirement. It was more about budgeting. How am I going to handle my budget? How can I invest more in the plan? Or debt? Like how do I have some more opportunities to invest based on the debt they have currently. So it was really interesting that the majority of the calls were not about how I invest my money, what the retirement plan can employ, is more about the ancillary services that have a direct impact on how much that they can invest in retirement plans. Any questions before I move on to the market? Again, I'm not going to go through this because you already heard this from NEPC, but one of the things I did want to point out, because it impacts a couple of funds that we're going to talk about here in a moment, is the international market. As we have seen this kind of on again, off again, tweet, no tweet about tariffs, a lot of money has started flowing into international markets. If you think about dollar weakness, lower valuations, we've seen a tremendous amount of investment going to the international markets. You can see on probably the second column from the right, developed international actually was up in the first quarter over 7%. That if I looked at performance for the EFA as of yesterday, that number is now 14%. If you think about emerging markets was up 3%. First quarter, they're now up 10% as of yesterday. So a lot of money has flowed into the international markets. I'm going to talk about two particular funds in a moment. And I'd encourage you to read some of our commentary. We always take a look at kind of headwinds and tailwinds, things that are driving the market in a more macro way, not the least of which is this push-pull with the Fed and the new administration. The new administration certainly wants the Fed to reduce rates. The Fed is going, we're not going to be quick on the trigger to reduce rates until we see the data that suggests we can. There's going to be a constant push-pull over the next probably a couple market cycles. And then I think just the one I want to highlight is a waning sentiment. Consumer and business sentiment has faded in anticipation of higher costs. And that's really something we want to watch out for on a go-forward basis. Over almost 70% of GDP is driven by consumption. And so if we start to see that consumption fade, that could portend to some issues in the foreseeable future. And I'll leave my comments to that unless there's any particular things of interest to you all. Yeah, this is the page I was talking about. Over 68% is consumption based. So if we look at the UMaine, what was there a comment? if we look at the Humane System Plan, again, this is a participant-directed plan, so we want to make sure we have enough offerings out there for the individual participant to create a portfolio based on their risk return preferences, but not overwhelm them with too much choice. So we think we've kind of had a good balance of enough choices, but not too many choices where they could be condemned by too many choices in the plan. As of the end of March, we dipped a little bit, about 1.99 billion. I think we surpassed a $2 billion mark at the end of the year. It is always at the bottom. It's always interesting to see, as you recall, for those that have been trustees for a while or have been involved in the plan, about probably 10 years ago, maybe 11 years ago now, we actually had 4 record keepers, and we consolidated the TIAA a number of years ago. But we still have assets in both Voya, Fidelity, and Corebridge, which were legacy record keepers. We just want to have a lens into like how much money are still with those particular record keepers. Penobscot did a really good job in some of the conversions of the Corebridge, excuse me, the Voya plan when we converted to TIA. I think that's why there's certainly a large percentage of the assets in brokerage as a result of some of that. If you look at the assets of the plan in asset class order, there's certainly TI traditional is prevalent throughout, that garners a little over 25-26% of the assets. We do keep an eye on frozen annuities. When we converted more recently to group contracts, a lot of the assets still remain in legacy annuities, meaning that if, for example, we wanted to remove a particular fund, those assets and legacy annuity contracts still remain with that individual participant. They have to elect to move assets out of that particular fund. But target date funds are starting to garner certainly more interest. It's a default, so somebody new joins as a faculty and staff member. They don't make an active election. We have a little over 17% of the assets in target date funds. So we have, this is again, in descending market value order by asset. We have 2 funds that are marked for review. I want to spend a little bit of time on this page, and then we'll go right into the performance and maybe our recommendation on your Pacific Growth Fund. But the first one, JP Morgan Equity Income Fund, this fund is scoring a 78 in our scoring system. As you recall, if a fund scores above an 80, it's in good standing. If it's between a 70 and a 79, it's marked for review. So this fund is in the higher 70s. This particular manager manages it in a very high quality manner. And so they have a tendency when periods of distress, they tend to shine, and is evidenced by the fact that the first quarter they did a really, really good job in terms of performance in the overall portfolio. If you think about 2023, 2024, when it was much more of a growth cycle, they tend to underperform in those particular environments. We're not particularly concerned on JP Morgan, but if we get to a period of extended, accelerated growth, that could be of a concern when the gap between those that might have a little bit more growth exposure in their value kind of oriented portfolio, if that gap is too large, we could come back with some alternatives. But at this point, we're not particularly concerned on the JP Morgan equity income portfolio. The Euro Pacific Growth Fund, this is a fund we've talked about. I think it began being marked for review, I think, in the 4th quarter of 2023. We always want to remain patient with a manager, especially when the market is entering a very volatile period. This particular manager, as you recall, has a growth tilt to it. It's still a blend manager, but they certainly have a growth tilt. And unlike the U.S. market that until recently has been dominated by the kind of the high-tech growth stock, the Mag 7 stocks, the international market, I think 4 out of the last 5 years have been dominated by more value-oriented organizations, think financials, think energy companies, healthcare companies, et cetera. That's been a pretty significant headwind for them. In addition, they have about 16% in emerging markets, and emerging markets have underperformed developed markets. And so as we've seen kind of this, we always want to be patient, but as we've seen more and more investment in the international markets, we were anticipating the Euro-Pacific Growth Fund would actually have a really strong quarter. They didn't. They now are scoring a 59 in our scoring system. And again, anything below a 69 is considered for termination. So at the end of the day, we have simply lost patience with this manager. There's no change in the particular structure of the portfolio. There's no change in the management team. They have a very solid process, but at the same time, when we see markets pivot, we would expect as an active manager, they would pivot as well to the degree that they can within their investment structure. They stuck to their guns. They continue to look at a more growth tilted mandate. And so we just think that it's time to consider a alternative to that. I'm going to stop there because the alternative is in the menu today, but I wanted to stop there for any questions or comments. And we can go to the scoring if we need to.
Barry, I'd just like to jump in while you're talking about the American Euro-Pacific Growth Fund. There is an error on the agenda, and on the agenda for action item title, it's also incorrect. It states that we're reconsidering the defined contribution plan for a recommendation for small company value fund change.
Yeah.
The action item summary is correct. It does have the correct information there. So if there's any confusion with action item 6 and the American Euro-Pac growth, you just need to correct it for the record. And when we bring it up for a vote, make sure to have the correct information there. So if anybody's confused with what Barry's talking about, it's not the it's the American Funds Euro-Pacific Growth Fund and not the small cap value fund change on item 6.
Thank you, Kelly. If we go, I'm going to go to page 58 just to see. So this is the performance of the 3 funds that are in the portfolio today that participants can invest in. And just by way of background, the Euro-Pacific Growth Fund has $24.1 million in it today, and that represents 1.21% of the overall portfolio. We have, three other foreign large cap blend managers. Euro-Pacific Growth Fund, MFS, is actively managed, and we also have for participants the index, the Vanguard Total International Stock Index, which also has emerging markets exposure. So if you look at performance, what stands out, I think, if you look at going the calendar year performance, Euro-Pacific Growth Funds began, at the end of 2021, they really had a really weak 2021, in particular, fourth quarter 2021. So you can see when the market was up almost 10%, this particular manager was up 3%. At the same time, when you look at 2022, most managers, again, certainly we're not immune to negative performance. So in 2022, Euro-Pacific Growth Fund was down almost 23%. Again, they're more growthy, so we would expect them to be down more than others. And then in 2023 and 2024, they right the ship somewhat in terms of the overall performance. But then you look at the first quarter of 2025, and it's almost like they went off a cliff. The market was all the money going into international. The MFS intrinsic value was up 8.5%. They were up 2.6%. And so because we already have a foreign large blend actively managed fund in the portfolio, our recommendation ultimately is to go to the MFS intrinsic value fund rather than offer another actively managed fund in the portfolio. Again, if you look at kind of where the assets are based on participant dollars, the Vanguard Total International Stock Index has about $43 million of the $2 billion in the portfolio, representing about 2%. MFS has a little over $34.5 million, representing a little less than 2%. And then again, the Europac has a 1.2% of the portfolio. So rather than look at another foreign large cap blend manager, ultimately our recommendation is to consider just replacing the Euro Pacific Growth Fund with the current actively managed fund we have in the menu, which is the MFS International Intrinsic Value Fund. The name is a little bit of misnomer. You think like value. Certainly, the MFS fund has a slight value bent to it, but at the same time, they're all both considered foreign large blend. Trustee Badley?
Oh, not a trustee, but
Sorry.
A year or two ago, obviously, I think we moved out of a pure play EM fund, and kind of from an allocation standpoint, we've been utilizing that Europac fund. So one of the concerns that I'm kind of tossing around here is, is there a good way for our clients a lot of whom utilize this fund lineup to get managed EM exposure in the portfolio? Was there any thought about reintroducing an EM fund by any chance? I know there's a little bit of exposure, obviously, in the Vanguard index, just not active.
Yeah. Yeah, and certainly we could explore that. The MFS Intrinsic Value Fund, if I don't have the chart with me, but if you look at Asia Emerging in particular, I think they have about 5 or 6% exposure to EM in that way, so that it's not like you're completely getting out of EM, but certainly it's paring back from what the Europac fund has today. If we were to entertain that, it's certainly something we would consider. We would probably be more of an advocate of a dedicated index product as opposed to an actively managed emerging markets fund.
Thank you.
I know I'd probably skip to tab 6, but we can go through the benchmark first, and then the fee benchmark, and then go back to this. But since I was here, I would at least, if you want to go to tab 6 and then come back to the fee benchmark.
And then do we want to, you know what, Barry, just go ahead through the fee benchmark, and then we'll take tab 6 in order.
Okay. And is Nate on now?
He is. I see him here.
Yes,
Welcome,
I am.
Nate.
Hello.
Hey, Nate, do you have the fee benchmark handy that you can pull up, and I'm going to stop sharing?
Yes, I will have it up. Is everyone seeing it?
Yep.
Okay, perfect.
Let's go to page 3. Periodically we want to kind of peer into TIA's administration services offering and commensurate with the fees being charged. And so as fiduciaries of the plan, we need to, and this deck will satisfy 2 items, is what is the fee that TIA is charging plan participants and if that fee is reasonable in the marketplace. So this is what the deck is designed to do. You know, because we have a lot of experience, we have a little over $1 trillion now in assets under management or advisement. You know, we are constantly going into the marketplace, doing fee benchmarks, doing RFPs, doing RFIs. So we have a really good handle on where the fees ought to be for the services being provided. Go to the next page. Yeah, again, it's meeting your responsibility and not only the fee itself, but is the fee reasonable? When record keepers look at plans such as the University of Maine system, they primarily the cost is driven by two primary factors, being the size for sure, as well as the average account balance. You think about a record keeping platform, there is a fixed cost to maintain a record on a platform. And so the higher the average account balance, the more efficient that portfolio is. Certainly cash flow, number of plans, complexity of the plans are also factors, but those are two primary drivers with respect to ultimately the fee they're being assessed that they're assessing to plan participants. So if you look at where your plan plays out today, we have 4 sample plans at the bottom that we're comparing it to. Just to orient you to this page, again, about $2 billion in assets. We have a little less than 16,000 participants in plan. We converted a number of years ago, as you recall, to a fixed per head fee of $49 per participant, and that equates to about 3.7 basis points. If you look at the bottom, the samples, sample plan A is a private university. They have a little less than 2 billion as well, 14,800 participants. Their fee is $28 per participant. Sample plan B, C, and D are two privates and 1 public university, all of them with multiple record keepers. And so when you look at where your fee is net at $49 per participant, it's certainly in range. However, if the trustees would like us to, I think you would, we would like to go and engage in a conversation with TIAA about your current record keeping fee with the eye towards lowering that cost based on our initial analysis here.
Yep. It's definitely, it's always a good thing.
Yeah. Yeah, we just think it's time. It's been probably a couple years since we did this. And obviously the market's changed, technology changes. And so the costs are continuing to drive downward. We think it's a good time to re-engage TIA in a discussion on this.
Have there been any recently renegotiated terms that you can point to, and how low do you think they can go?
I mean, the good news is they don't have competition anymore. So we have 1 record keeper, so that's certainly a lever that we would pull pretty dramatically. It's hard to say. I mean, I don't want to I don't want you all to be disappointed if we get down to 45 or 40 or something like that. I do think there's room. I'm just not sure exactly how much room until we had that conversation. That's maybe a non-answer, but it's kind of like until we have that conversation and they engage why the fee is the way it is, I hesitate to make any sort of guarantee. But I think there's room for sure. Now, if you look at this, the sample plan A is pretty similar in the sense that it's a single record kept plan, but it's only 1 plan. You have 7 plans, so that certainly adds some complexity to it. So we don't think we're going to get to the 28, but we do think perhaps probably aspirationally we could get into the 30s. Does that answer your question?
Yeah,
Yeah.
thanks.
Yeah.
Probably be worthwhile if you could maybe send updates on how that's going, and if there's an opportunity for somebody from the system to help, that would certainly be in the constituents' interest.
Yep. Agreed. And we'll certainly engage with Tracy once we have that initial conversation. So
Yeah, happy to participate in that. I would also mention over the last several years, since the investment committee approved small sum distribution process, our average balance size should be increasing. So hopefully that will help us in our negotiation there.
that's a really good point, Tracy. Yep, for sure.
That's great. So, any other questions for Barry? Barry, are you all set with us to move to tab 6?
Yep.
Okay, and I just want to apologize on your agenda. The agenda item, the title is incorrect, but the summary on the agenda summary page is correct. So I'm going to read the entire background and the text of the proposed resolution. And if I'll pause before we take a vote, if you have any questions for Barry. You did a good job going over that. And it just says, basically, CapTrust Financial recommend that the committee consider a fund change in the defined contribution plans. Both of the following funds are currently available in the plans. The American Funds Euro Pacific Growth Fund is a foreign large cap blend fund with a growth lean. The fund's returns have underperformed the benchmark in peer growth over the past 7 years. And the MFS International Intrinsic Value Fund, the foreign large cap fund, blend fund with a value lean. The fund returns have outperformed the benchmark in the peer group for most periods measured. And you had gone over that in detail, Barry. And what the text of the proposed resolution is that the Board of Trustees, acting through the Investment Committee, approves the CapTrust recommendation to terminate the American Funds Euro Pacific Growth Fund, replacing the fund and mapping the assets and contributions to the MFS International Intrinsic Value Fund. Do I have a motion?
So moved.
So moved by Chair Riley,
Second.
second by Trustee Moore. Do we have any comments, questions before we take the final roll on that?
I'm sorry, I hate to be the guy who does that, but just one more question for clarification. Is there a specific reason to be mapping that to the MFS instead of the Vanguard International?
Yeah, I mean, it's the premise is that, and I appreciate the question. The premise is that people have made an active decision to go into the Euro Pacific Growth Fund. They've already had the Vanguard Total International Stock Index on the portfolio already, so they could have made the decision to go to a passively managed offering. So we want to, and as best we can, keep their preferences pure in the sense of active to active.
Great, thanks.
Any other questions? Hearing none, I'll pass this over to Beth for a roll call.
Trustee Martin,
Yes?
Trustee Riley,
Yes.
Trustee Worth,
Yes.
Trustee Moore,
Yes.
motion carries.
Excellent. That gets us to the end of the meeting.
I mean, I'm like, wow, we were going to start at 10:30.
I know. Record time.
Yeah.
Well, thank you, Barry and Nate. And thank you all for attending the meeting. Appreciate your time. And for those of you that are going to be in Presque Isle, I will see you, and I'll see you this weekend. And I know that the non-voting members probably only see you in September. Our next meeting is September 25th. So those of you I won't see, have a nice summer. Everybody else, I'll see you this weekend.
See you this weekend. Thank you.
Thank you.
Take care.
Take
Thank
care.
you.
Thank you all.
Thank you.
I can never find the leave button.